Hello and welcome to Legal Thinking from RWK Goodman. I'm Liam Pear. In this episode, we're joined by Milan Kapadia, who is the head of dispute resolution in our London office and also the head of our banking sector group. We discuss some very topical news, which is the collapse of Silicon Valley Bank, also known as SVB in California, and what has unfolded since then. In this episode, we talk about why it happened, what maybe made it more prone to happening there than other banks. It's also worth mentioning that we discussed the reported ring-fencing waiver that happened when HSBC purchased the UK arm of Silicon Valley Bank. But without any further ado, let's roll tear. So thank you for joining us, Milan. If you could just start off by explaining what happened and give us a little bit of background.
Thanks for having me, Liam. And I think just to start the discussion off, it probably makes sense to go into the background of the bank a little bit. So Silicon Valley Bank was a Californian bank. It was, founded in 1983 and was the 16th largest bank in America before its collapse. There is a separate UK division of the bank, which is known as SVB UK, which is sort of, I think, what's triggered all the media and the press in England. And we're going to talk more about that in this podcast. The main business of the bank was financing and banking for venture capital-backed startup companies, and mostly tech companies, as you'd expect with a bank called Silicon Valley. Venture capital firms did business there as well as several tech executives. SVB, at its peak, actually even up to its end, provided finance for about half of all US venture-backed technology and healthcare companies. So it was a really well-established and popular bank there. And also in the UK, where it had around 3,500 customers. What also made it so popular in the sector was that it supported startup companies that not all banks would accept or support because of the higher risks associated with startups. And then the pandemic came, and 2020 was a hot market for tech companies. Consumers are spending lots of money on digital services and electronics, and tech companies had a large influx of cash, and SVB was a popular choice to hold cash for these businesses and their expenses, such as a payroll. This collapse of SVB is, however, the second largest failure in banking history after since the global financial crisis back in 2007, 2009. So what went wrong earlier this month is really the big question. As I mentioned earlier, SVB's customers were mostly tech startup companies, and it was the money of those investors that was deposited with the bank. This increased over the last few years with the booming tech sector. And at the end of 2022, SVB, as a global bank, had assets of around $216 billion, so it's not a small sum. In 2021, it had deposits of $116 billion, so it almost doubled over the last 12 to 15 months or so. It was these deposits and this cash that it was holding for its customers that really, I think, gave rise to the issue. So banks, they typically do, they invest those deposits in various ways. But over the last few months, I think up maximum of a year, they changed their investment strategy. And so they changed from short-term loans to investments in bonds and treasuries. And now these are long-term investments that have a set life of the investment and a set interest rate. But the trouble is that they work conversely to interest rates, and we all know what's happening with interest rates at the moment. So with increasing interest rate rises, bond and treasury returns and values plummeted. So SVB's assets looked like they were depressing in value, and they had to raise capital to make sure they were meeting their regulatory requirements. And this is where the problems really started. So on 6th of March of this year, SVB tried to raise capital to the tune of $1.7 billion. And when they publicized that and announced that sent a really bad message to the market that, the bank was short on capital. They then tried to sell the bonds and treasuries that they had previously invested in. And reports suggest that they had to sell them at a huge loss. So this further affected their finances and their balance sheet. Had they held on to those bonds, this problem might have been avoided. But the fire sale of those bonds really affected them. Word then spread. It got out in the media, and actually it was social media that compounded the speed of SVB's collapse. So these the tech startup companies that would deposit their money with a bank, they have their CEOs and their executives that are controlling all the money, and they took the decision to go to the bank to withdraw their deposits as soon as the news of their fundraise hit the markets. And to make matters worse, these CEOs and these tech executives started posting on Twitter, which provoked the fear and the numbers of people wanting to withdraw their funds. And by posting, they were essentially fanning the flames of the bank run. The share price in the US of the bank plummeted around 60% by the next day, so on the 7th of March. And then the FTSE share values also dropped by around 2%. HSBC's share price in the UK, which we will come on to later, also dropped around 4%. So this is, within 24 to 48 hours of the fundraise news becoming public. And then, 2 days later, so this is on the 8th of March, the bank collapsed and it was shut down by Californian regulators.
And what does the collapse mean for fintechs, tech firms, and other banks?
So the immediate impact of this is that the money that these tech startups were trying to withdraw or use, that money was intended for their expenses, their business expenses and their payroll. And the people of these companies, the staff are their lifeblood, and failure to keep up those payments would have had a major ripple effect. So the inability of the businesses, the bank's customers, to withdraw their cash would have had a major ripple effect on those businesses. And the first thing that regulators do when banks fail is to, have some sort of interim measures and control over what happens with the funds and the deposits to make sure that the problem doesn't become worse. The people that were affected by SVB's collapse are their customers, but also their investors, meaning the investors in the shares of the banks. And as I mentioned earlier, the share values of, they dropped and essentially are worthless at the moment because the bank in America has gone to liquidation. Not the same in the UK, but I'll come on to that in a second. The customers, however, are protected by the Federal Deposit Insurance Corporation in America. And we have a similar scheme in the UK, which protects deposit holders in the UK, but the investors were not. The concern now is for the tech and life sciences sector, which has been hit by recessionary conditions. And many of them were, and I think still are, cutting staff. SVB was one of their major supporters, and with it now gone, startups may face funding issues if other banks are anxious about funding what are traditionally perceived to be risky businesses, so, the startup sector. And to give you the impact of the closure of SVB, I think I can tell you some examples of the types of customers that they had, and some of these are modern day household names, and they are huge employers. And you may be familiar with Etsy, which is a major global online marketplace. They used to bank with SVB. You got Roblox, which is an online gaming platform, which I only know too well because my son spends far too much time playing it. You've got Rocket Lab, which is an aerospace manufacturer. And you've got Roku, which manufactures media devices for digital streaming. And you asked about what remedies, would have been available if the bank had folded. Mm-hmm. So in the US, the bank has folded. And as I mentioned earlier, the customers were protected by the FDIC. It has, however, transferred all deposits to an interim bank, which has the snappy name of the Silicon Valley Bridge Bank. So customers can have access to their funds and deposits from this interim bank. In the UK, had it gone into insolvency, the 3,500 customers that I referred to for SVB UK, their deposits are protected under the Financial Services Compensation Scheme, up to a limit of £85,000 for a single account holder and £170,000 for joint accounts, and that includes companies. And customers would otherwise have had to go through the process of proving in the insolvency of the bank, which takes into account any loans that they had to repay to the bank. And at the end of the insolvency process, they would have just received a dividend, which is really only a percentage of available assets. And if you look back to the Lehman Brothers insolvency, they the dividends and the payments out to creditors and customers of that bank only really started flowing out, I think, 10 years after the insolvency. So it takes a long time for that process to conclude. And I did a bit of digging, and it seems that the current report suggests that the bank's customers had average balances well in excess of $250,000 or pounds in the UK, I believe. So, these are sizable deposits for all of their customers.
So, what was agreed in the HSBC bailout of Silicon Valley Bank, the UK arm of it? And is what happened common? And how does a takeover of this type work?
Yes, that's a good question, Liam. So it's important to distinguish between the American and the UK operations of Silicon Valley Bank. HSBC has not acquired any of the US operations. The US government will also not be bailing out SVB America. It will remain a collapsed bank, and it closed on the 10th of March. I mentioned the interim bank that's been opened earlier. The US government has, however, agreed to guarantee all deposits of those SVB customers, not including investors and unsecured creditors. In the UK, however, the Bank of England did initially decide on the 10th of March to place SVB UK into insolvency. And had that happened, our UK banking insolvency procedures would have come into play, with liquidators being appointed and oversight and transfers being monitored by them. However, the UK government did strike a last-minute deal for HSBC to buy Silicon Valley Bank UK's operations, saving thousands of British tech startups and investors from losses after what is the biggest bank failure since 2008. This sort of arrangement isn't all that common, which is probably a good thing, as that's a sign that our banks are well managed and protected. And as part of the deal, HSBC paid £1 for the assets of SVB UK. HSBC now has an additional 3,500 customers, including venture capitalists and tech startups. SVB UK itself was profitable, and last year it made profits of £88 million and held around £6.7 billion in deposits. The addition of SVB UK to HSBC only really comprised around 1% of HSBC's overall business. So in the scheme of things, it's not a huge addition to HSBC's business, but it's definitely an important part of the banking sector. And it was, to avoid the collapse of SVB UK and abandoning all those customers. What this all really means is that the risks to public funds, and therefore us, the taxpayers, is limited by ensuring that to the extent that there are losses within SVB UK, it'll be the shareholders and the creditors of HSBC that will bear those, and not the deposit holders of SVB UK, who would have claimed under the compensation schemes or the insolvency of the bank had the transfer to HSBC not been approved.
So what does the ring-fencing waiver from the government mean? And is this a statement of intent given other proposed reforms or standards?
So the ring-fencing waiver from the government, that is something that was introduced after the global financial crisis from 2007 to 2009. Legislation was introduced to ensure the better management of banks. And this included something called ring-fencing, which aims to protect UK retail banking from shocks in other groups and other financial markets. In other words, core banking, which is the taking of deposits from customers, people like you and I, the making of payments within the banking system, the giving of overdrafts for to individuals and small businesses, all of that has to be treated as financially and operationally separate from the investment banking and international banking activities of the bank. And it's almost like ensuring the right hand doesn't take from the left hand. The exception to this rule was brought in last week by temporary legislation, and it involved the reduction of some of SVB UK's capital instruments and allowed some complicated corporate customers to basically be housed within the ring-fence part of the business. And this enabled the transfer of the assets to HSBC. I think this is a statement of intent, and it's a sign that the government really and the Bank of England really didn't want this bank to fail. And it's also a sign of the government. I mean, if you do some reading in the white papers, the government did sit long hours over the weekend to try and introduce this emergency law. And they really wanted to not only support the bank, but to support the tech and life sciences sector, which they see as a really important part of the world economy. So it was a statement of intent on multiple levels. I think we might see some further legislation and regulation to manage some of the risks of banks, but yes, this was a very intentional and well coordinated and planned move by the Bank of England and the UK government.
And finally, you touched upon this a little bit earlier, but Silicon Valley Bank was extremely popular amongst tech startups and tech companies, and their offering made them appeal to those kinds of businesses. But appealing to tech startups, is that not a little bit risky, and did that not make them more prone to collapse?
Possibly, but I don't think this is what caused the collapse on this occasion. I think there were a combination of factors. The tech sector is a risky sector, what with the high rate of attrition and businesses that don't make it past the first year. Further, the heavy reliance on venture capital makes the longevity of these businesses difficult to predict. And when venture capital dries up, these companies need to start using their own cash reserves. And that's when the banks need ready access to large sums of money. There are issues with venture capital drying up at the moment, but the combination of inflexible investments, so the bonds that I referred to earlier by Silicon Valley Bank, and the social media panic and the rush of customers wishing to withdraw their money, all of that, I think, triggered a negative bank run and the panic that ultimately led to the demise of the banks. And there are regulations that require the banks to keep a certain amount of capital in the bank. So it was a combination of all of those things, not specifically just the fact that tech startups were their customers. So, there need to be rules and regulations to manage the investments. There need to be rules and regulations to maybe manage social media, which we know is a very tricky thing with Elon Musk's recent acquisition of it. And so, yeah, I think it does make these banks maybe slightly more risky. But I think the lesson to be learned is that the financial system is still quite fragile and more fragile than the public have been led to believe. I think that there is a chance that we might see more regulation and scrutiny, which might have a wider impact on the economy.
Milan, thank you very much for your time.
Thank you very much, Liam.
Thank you for listening to Legal Thinking, and thank you to our guests for joining us on today's podcast. If you want to find out more about the topic that was discussed today, make sure to have a look in the show notes where we'll have linked everything up.
And you can find all of the back episodes of Legal Thinking in your podcast provider of choice, and you can also subscribe and follow us on there too. And as always, make sure you leave us a 5-star review on a podcast provider of choice, as that helps other people find us. Thank you very much for listening, and we'll see you next time.
Bye-bye.